Probably the new thing is the advent of inflation. Inflation has been absent from the global scene since before the financial crisis, but we're approaching a point of full capacity in the US economy. It's also true north of the Alps in Europe, and has been true now for some time in Japan. And I don't think the basic laws of economics have been repealed. As we approach greater utilization of all resources, labor as well as product, we should see wages and prices begin to accelerate. As a result, central banks will have to respond, and that's a very different environment than we've been living in for the last 8 or 9 years. So over the last 8 years since the financial crisis, a blend of stocks and bonds, perhaps with some corporate credit, and maybe a few alternatives, has served insurance companies as well as other investors very well. Returns have been strong. They have also been relatively low volatility, and therefore portfolio performance by conventional measures has been very promising. In the world we're describing, it's likely that returns will be lower, partly because valuations are already high, partly because underlying macroeconomic conditions are shifting in ways that are less predictable. And as a result, I think that insurance companies will have to try to build more robust portfolios comprised of assets that are likely to perform well in that environment and that are not well correlated with one another. Dispersion in markets is improving, which suggests that long-short strategies may also be a source of incremental return. And in general, what insurers as well as other investors should be looking for is steady, lower returns accompanied by smaller drawdowns, since overall performance is unlikely to be as strong as it has been in the past. So I think for insurance companies, the issue of inflation is an important one. We've lived in a world without it for a while, and perhaps investment strategies have forgotten how to be managed in that world. I do think first recognizing that the risk is growing is important. Secondly, there are some risk mitigation techniques. Inflation-linked securities are a well-known way to protect against inflation. Real assets can also be part of the solution. Long-lived assets such as infrastructure spending are also typically good performers in the world of higher inflation. It's important to note, however, that portfolios will be more at risk if inflation accelerates. It tends to undermine the value of both stocks and bonds. So conditioning expectations of management of the end users of the capital is also important. It's going to be hard to find portfolios that work in a world where inflation is rising.